Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of ORATS, an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to talk about customizing an options backtest using signal dates and indicators. We'll be pushing the legacy backtester to its limits and experimenting with indicator ratios, signal dates, and other entry criteria such as intradays and hedge days. Matt, do you want to get us started by going over our positions from last week?
Sure. Thanks, Tyler. Yeah, I'm just looking at an iron condor that we've had on for almost a month, and so down here is -15, -17. So it's come up nicely to levels that we have a profit and loss exit alert on there at 50%. So I think we got in at 12, and we didn't quite get stopped out at 15 or 16. 25% was our loss. So we're still in that. We have a good profit now. Let's see, we sold for 10.23. It's 6.88 right now. So we're waiting for half of that, so 5 something to get out. We also have a long put diagonal that's doing well. So we sold the 5.15s in September at $4, and those have largely lost a lot more than we've lost on the March diagonal. So these are the types of trades that I like, Tyler, because you could get some downside protection, and the market's been generally up from this time, and we still have made some money. So you're getting it both ways there. The risk is if it goes way down really fast to this level, 5.15, that's when you way off the chart here is when you would start losing money there. So those are 2 open. We also had a CVX that we sold for $1.18, and then we had exit alert on there that triggered. So we lost a little bit on that one, but we got out discipline. Of course, the stock's higher, and we would have been a better winner, but you win some and you lose some with the exits, Tyler.
All right. Thanks, Matt.
Yeah.
So this week we're going to look at the legacy backtester. We'll be using that a lot, and that's where you can plug in a bunch more entry criteria, signals, indicators, all that stuff that you can't do in the regular custom backtester in the dashboard. So we're going to be using that to look at signals. We've been doing a lot of work with signals, so we're going to show you guys how to do that, so you can test different strategies and different indicators that you have.
Yeah, and it's probably a good time to delineate the backtester, the dashboard backtester versus the legacy. Legacy's clearly been around a long time. ORATS is known for our backtesting, and largely because of the legacy backtester. The reason we put the backtesting in the dashboard, this huge table, is we found that people wanted a head start. So we've run 181 million backtests for people, and you could just sort through. And we've had a lot of the popular triggers and the popular entry and exits. But what we're going to do and talk about today, Tyler, is clicking on this button and going to the legacy backtester, where you can customize a lot of the ones. When you pre-run a lot of strategies, you have to make decisions on levels because there's already so many that we've run. But you could, like I said, get a head start and then come over to the legacy and run the backtests that you might want and you might think are beneficial.
Right.
So you start by getting to the backtest. If you have any backtest history, of course, I have a ton there, and then you could then create your own backtest. So it starts with entering a symbol. I'll use IWM, and then you choose your strategy type. We'll do a neutral strategy. We're going to be let's do an iron condor, and then you set the dates for the days to expiration, and then you set the deltas, and you could set additional parameters. And we're going to be talking about these a little bit. You could even set ratios on certain ones. We could have different types of iron condors. And then we could set things like entry days. What that does is if you have a long-term test and the stock moves a lot, all your options are kind of out of the money, and you're trying to assess, how well a certain strategy does. Well, entry days automatically puts on extra trades every certain number of days that you specify. And then it takes what we call path dependency out of the results. Spread yield percent, that's a good one to define how much you're going to pay for a particular or get for a particular option trade. And that's in terms of the stock price. So do you want to get 1% for the iron condor, or how much do you want to get? And, there are a bunch of other indicators there, including indicator triggers to get in. There's also indicator triggers to get out, and getting out based on profit and losses, or how much of the strike differential have you picked up already in your prices. So there's a lot of bells and whistles here, Tyler. But what I'd like to do is talk about some of the ones that we've used lately.
Yeah, that's great. I just posted a link to the descriptions of all the entry and exit criteria. It's in ORATS University, so you guys can go there. We're not going to go over all of them today, but if you want to look at what each of them mean and some sort of examples, then you can go to that link.
Right. So I think it might be helpful to talk about, how we go about identifying indicators for particular strategies.
Yeah, I think that's a good idea, because we have hundreds of indicators, right, that measure constant maturity, implied volatility, slope, historical volatility, ratios to best ETFs. There's just a huge number of them, and it's sort of this question: where do you start, right?
Yeah. So, so my approach was, well, let's get all of the indicators that I think are decent, make sense, and are positive. What I think would have a positive outlook on trading. A lot of these are forward relationships. These are implied volatility forecasts versus components on a 5-day average. So, I mean, it's like a large number of them. I have almost 200. And what I do is I go through and I say, well, I know of a typical, this is IWM, short SS hedge is a short strangle that's hedged with stock. And so I have these returns, and I have all the readings for all these indicators. So, what the first step I do is just go and see if any of these indicators in sample have any benefit of following. For example, contango. We've often argued that high contango should be good, and I like to show a picture of contango because I think it's interesting to look at. So when we talk about contango, we talk about when the front month volatility is lower than the back month, which we're in right now. And that usually indicates a calmer market, even though it's been a little bit volatile. But volatility, this is SPY, and volatility has come down quite a bit lately. And then let's go down to contango. So here's the term structure, and it looks a little wonky, but if you just look on the overall, it looks like the front month is here and later is here. So, what you want to see is lower front month, and then that will kind of indicate that the market is that's the case in most of the time. The market's in contango, and we have a graph of contango over here, and it's highly positively correlated with the stock. So you could see that when the contango came down precipitously, starting in early July, the market came down with it, and you can see that it reversed and has gone up from early August to now mid-August. Interestingly enough, it's come down a little bit here, but again, those blips are somewhat noisy, so you have to just we usually will watch it with a moving average. So this is one indicator of a couple hundred that I'm using, Tyler, and it's helpful, I think, to graph it and to see like how would you use that if you were trading and manually doing it. How would you use that to get in and get out of particular strategies, especially when you're looking at the contango is oppositely correlated with implied volatility in a lot of ways. So when vol started going up, that's bad for short vol strategies, good for long vol, but when vol is coming down, the opposite. So that's why a lot of these indicators are so important, Tyler.
Yeah, it's really cool to see it in a graph form there. And like you said, it's only one of many indicators that we believe are reflective of stock price, and I think even more importantly, reflective of strategy performance.
Right.
It's really hard to predict stock price because of all the confounding variables like news and macroeconomic events. These indicators are specifically related to the volatility surface, right? Every option on SPY. So we have a lot of options and indicators, and they're very effective for strategies.
Yeah, that's a good point. Whereas most people are used to like hey, I'll try to pick where the stock's going, and they use the stock price to do that and change in stock price. We're using returns from an option strategy. So in my kind of ugly spreadsheet over here, I have every day what the returns were for a particular strategy. And so then what I could do is treat this like the change in stock price, which people are used to predicting. But now we think it's a lot easier to predict an option strategy because it reacts to a lot of the indicators that we've spent so much time in developing and getting right. So now what we could do is start to do some of these tests where we go through each day. What was contango at? Was it above its standard deviation? Was it above half of its standard deviation? If so, maybe that's a entry point that we could test. And so these are all kind of tests against those types of strategies, and these are the returns per day. So we then start to say, okay, this worked in sample pretty well. The negative worked. So if you would have put it on when the opposite was true, when contango was high, you would have lost money. So that's really good. You wouldn't see that. And then this is all in sample. Then you would do the same tests out of sample. So these are run from 2007 to 2017, roughly 10 years. And then the in sample is from 2017 to today. So roughly 7 years. So we'll be able to test this out of sample. And one of the cool things that we can do is we can take this outside data, because some of this data isn't in the backtester, even though a lot of entries are, but a lot of them aren't. And so we could formulate our own entry days and exit days. So we'll come up with like a date. So I have a whole list of files that I could just drag in. So what I do, Tyler, is I'm just able to, it makes these automatically, these entry, and I'll show you what it looks like. So this is get in on the 30th of 2018, get out in 2018. This is again after 2017. Get in June, get out in July. So these are all the entry and exit times. And so then what I could do is we've made it pretty easy. You just go in to the legacy backtester, choose your strategy, and then just click edit and advanced options, go over to this and drag it in. And now these dates are in the backtest. So I'll just run that backtest and it'll only get in and exit at the signal. So just see what that looks like. And then you could say, which one did I do here? This one looks, this one worked pretty good. So then I could say, well, what are the inputs here? So here you could download the entry and exit dates that you've already done, and then you could see, what those were. This was a different one, but so these are entry and exit dates, and then it will only trade on those dates. And so that's, I think, a really neat way to, that's just one of many, but it gives you a lot of flexibility. That's what the legacy backtester does. So just to reiterate, I found a indicator that I liked, and on the certain days when it was in a certain space that I tested before, in this case above 1 standard deviation of its average, I got in on that day, and then I got out when it went to 1/4 of that standard deviation. So if it went below that, so I'm looking when a high contango happened, and I get out when it goes almost to the other side, and then how well did that do? And that's definitely one way that you could use to test symbols, test ratios, test, and this could be done using ORATS data, which is, I have all my ORATS data over here. These people would call that independent variable. So I have all that data there, and then I'm testing against all of the actual returns there. How's that sound so far, Tyler?
Yeah, it's interesting you're playing with this. There's so much ORATS data, and there's so many indicators to analyze. Right? You have to sort of think, like, be very methodical about your testing, and how you're making the entry and exit dates.
Yeah.
You mentioned a lot about separating out training and testing, in sample, out of sample. Really important to make sure it's not forward looking. That would be, forward looking is an example. Like if you found the best indicator of your data set, but that data set included every year from 2007 to 2024, and then you put that in the backtester, it wouldn't be very statistically sound, because you have to test in sample, out of sample. Otherwise, you're making it forward looking.
Well, forward looking too is when you will have a data point, like that's a moving average that uses date in the future that you wouldn't have known at that time. That's right. Or if you use a return, like sometimes you screw up and you'll use a return from today's date when you would have known that. So you could only trade at a particular time. So ORATS gathers its data 14 minutes before the close. So on this day, 1/3/2008, we could have traded at that time, and we have all of the strike information. So we get in on that day, and the first profit would be the next day, because we don't know what it is until we go look on the 4th and say, oh, at exactly 1 day later, you lost 18 basis points or whatever.
Yeah, it's very fun to see all this data. I mean, when you look at stocks, you have just a few data points you can look at, right? But with options, there's so many that measure the volatility surface.
Yeah, I mean, it's hard to make a generalization on stocks. It used to be that way, where everyone just used to use stock price and moving averages and all that. But now, people are using, the amount of freight on a train going through Chicago. Like they'll measure all these things and then make models, and that's what they'll use to trade. So it's insane, all of the data that goes in now. But I think you're right, Tyler. For options, you really need to get in and take a deep dive on, like this. I'm just looking at some of the ones that we have. Forecast of the next 20 days of historical volatility. Forecast of where implied volatility will be in 20 days. Forecast of where the 2-year implied will be in 20 days. Where the actual volatility is. Volatility of implied volatility. Put call slope. So it's all these data points, and I haven't left the first page here, and it just goes on and on. And all these are important, we think, and we use these in and then we use the component weighted averages too. So you have to use it, get all the data that you can. You're trying to create alpha. You're trying to do things that other people don't do, and sustainable alpha. So it's difficult to do, but this is, I think, a very good way and very good approach to doing it.
Yeah, and it's testable too in the legacy backtester. So just for everybody watching, if you want this data, you can get it on our website by signing up for the historical data package. Specifically for this data, it would be the near end of day. And then you could also get some of it from the data API as well. That's more query based if you were looking to just get some data, like just for SPY, for example.
Right. And so, yeah, that's how we started. I did this all from the API, and we have an API that also works within Excel. So that's what I know. So that's how I get it in there. And when you and I work together, you have all the fancy programming, but I go through Excel, old school ways, and then we work off of each other.
Yeah.
To try to come up with the best type of methods. I think what we could talk about is also hedged versus non-hedged. I think is interesting. Do you want to talk about that for a second?
Yeah, so let's talk about that and the intradays as well. So these are very important parameters to put in the legacy backtester when you're testing signal optimization like this. So when you're putting in those entry and exit days, it's very important to pay attention to these two entry criteria.
Yeah, so as Tyler said, there's hedged days and there's entry days. So entry days is, and I talked about briefly before, is you get in on a certain day, and if it's 45 days till you get out, I mean, the stock could have moved a long way during that time, and your original trade that you had on here might be way in the money or way out of the money now. But if you keep putting on trades all through that time, then you're going to be it's going to be more representative of how the strategy would actually work, and wouldn't have this is called path dependency, when the path of the stock determines the profit of the strategy, and you want to avoid that. So you could avoid that by setting entry days to 1, entry days to 2. So you're entering the strategy every 2 days, and not just entering at once and sitting back. So that's what entry days is. And you'll notice it's 0 in this one. The reason it's 0 in this one is we're actually testing the signal for this one, so it should be different. And this is where it gets complicated. When I'm testing, when I'm trying to develop indicators, I'm using entry days equal to 1. So I want entering every day, and I want an accurate representation of how the strategy would perform. And then I also put hedge days equal to 1, because often if the underlying stock price moves, you'll have an outstanding delta in the backtest, and deltas aren't what you're trying to predict. Deltas like predicting stock movement. We don't predict that. We want to predict volatility movement, pricing of options movement, relative value movement. So we turn hedge days on, and what hedge days does is every day it hedges the delta out. So if I start with a long straddle and the stock goes up, I'm getting longer, and I want the stock to continue to go up. Well, at the end of the day, in the backtest, we would sell that, because again, if it does go up the next day, that we think is kind of a random occurrence, and we want to take that out of the backtest. So we want to be isolating the alpha generating premium that we could predict, and not delta movements. Does that make sense, Tyler?
Yeah. I think it's important that the difference with the entry days, when you're getting the returns to analyze versus testing the signals, they're 2 separate backtests.
Exactly. Yeah, and I should also emphasize that when you now have the signal that you want to test, you don't want to have entry days, because the signal is strongest when you get in. So if you're doing entry days, you're going to test on the opening day, and then let's say it's a 10-day buy until the sell, then you'll be buying every entry day. So you'll have 10 trades on every different day rather than one trade on at the most important day. That's the entry day. Because if you remember back, my signals were I'd have an opening trade that would have more requirements than when you're exiting. So you're exiting, like I said, contango, what was one standard deviation over, and then I'd get out when contango was 0 or flat. So I don't want to be entering trades during that time. I want to get in and get out on that original trade. So hopefully that's a little bit more complex, but those are the things that we think about when we're testing these signals, Tyler.
Yeah, it's like when you're testing signals, you want the path dependency because you're trying to make that path. That's what the signal is the path.
Right. So unless you have anything else you want to cover, I think we should probably get a trade on, Tyler.
Yeah, let's do a trade for this week.
All right. So it's a little hard because I haven't looked. Ideally, I would have done my homework and found out which good indicator is going right now. But let's do a short strangle in IWM, and then we'll back that up with a way out of the money long strangle because I never like being totally naked short units.
Sounds good.
So let's take a look at our short strangle inputs. So this is actually the test case. So I'm gonna look at the non-test case. I'm gonna look at a test that I like, and actually we'll try to see if any options come up, because theoretically it shouldn't come up unless it meets the criteria. So let's try this one. Yeah, no scanner results for that one. This is going to be a little bit hunt and peck, but that's how it is sometimes. Yeah, so no results. So maybe they aren't. Maybe we should do a long strangle today. Should we do the opposite since none of our signals are matching?
Yeah, we can.
Okay. Let's have some fun with this then. IWM. Oh, this is scanning. I'll clear all these settings. So we'll do a long strangle. We'll take this. So we're going to do the highest rating. We're going to let's use our forecast a little bit. Risk reward is in there. So it's coming up with let's take a look at this 210, 224, Tyler. So it's got a decent amount of green, 20% profit chance, break even 206, 227, or 214. What do you think?
Yeah. I mean, is there anything telling you this stock's going to move a lot?
Well, it's a counter argument, right? So none of the good signals are for selling are out there. So I say, okay, let's buy.
All right, let's put it on.
All right, so I'll give them it's 384. Yeah, we'll give them 3 cents, so that should work. We'll force that. Take a picture of it for next week, and review the order. All right, so that filled, and we're in. And I'll save the picture here, Tyler, and I think we're good right underneath the 30-minute mark.
Perfect. All right, thanks, Matt. Very good show with the signals and the legacy backtester. You and I are working a lot on it, so hopefully we have some members of our community working on it as well, and we'll see what we find. If you guys have any questions about our tools, you can email us at support@orats.com or comment in the comments below. Or if you're a subscriber, you can even post on our community feed. Thank you guys for watching. Thank you, Matt, and Trader for hosting, and we'll see you guys again next week.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.